Hey, what's going on, ladies and gentlemen? Back after taking Monday. Well, market wasn't open on Monday, so didn't do a show on Monday. Did want to talk to you guys today about the debt ceiling, but as you notice, there is a boat on the screen today. This is the boat that I built. Actually, I've gotten a few comments over the last year or so asking me to post a picture of the boat that I built. That is it. It's an 18-foot center console made in the Carolina Dory style. So that's just something for tooling around the local kelp beds in the bay. It's been a lot of fun, but I haven't had a chance to take it out very much, but I'm going to later. So let's talk a little bit about the debt ceiling here. Okay. So this is the graph of US debt in gray and the debt ceiling. This was put out by the Treasury Secretary Janet Yellen through her address to Congress on January 19th, and that's today. And so let's talk about that for a moment and why she's addressing this now and why emergency measures have been taken. So largely, the debt ceiling has not been a political issue until about 2010. Okay. You can see that the debt ceiling never really, or debt rather, never really caught up to the debt ceiling until very briefly, right around 1995, 94, 95. And then it wasn't until 2010 or so that it became a big matter politically, and a lot of people started talking about it. And really, it is a political weapon or a political toy of a certain party. That's not to say that we don't need to address the issue of national debt. We definitely do. This is not a good thing, especially when you look at the growth of national debt since roughly 2012. It has gone from about 15 or $14 trillion up to 31, $32 trillion. This is a huge issue. We've seen a doubling of our national debt in just that 10-year time span or so. And this is something we need to address seriously. And the problem is that no one wants to address this in a serious manner. They're just using it as a political weapon now. So in the past couple of years, since 2014, the debt limit has been suspended twice. It was suspended from 2014 to 2016. There was no debt limit. Okay. And so national debt to versus GDP, I think ours right now is just over, it's like 120%, maybe a little bit higher than that now. For example, Japan's is probably the highest at 160% GDP. The 100% GDP or debt to GDP, Chris, I'm sorry, I'm addressing a comment right here. I didn't highlight it first. Would be interesting to see national debt versus GDP. So the first time that national debt was 100% of GDP was way back in World War II. And then we saw a decline in debt from World War II through about the 1960s. And that's when a lot of the sort of greatest generation, the first of the greatest generation, really started to go into retirement in that time period, meaning the oldest folks who were involved in World War II started to go into retirement. And we saw baby boomer expenses and baby boomers start to move into adulthood, which was the late 1960s. That's when we saw GDP start to grow again. So I don't talk a lot about generational arguments or characterization of generations on this channel. Maybe I should at some point, but national debt is a baby boomer issue. The country essentially did not have a issue with national debt until baby boomers were in charge. Now, when you look at the composition of generations and how quickly generations came to power, the baby boomers came to power sooner politically than any other generation in history, and they've held on to power the longest. And a lot of that had to do with just sort of the confluence of political movements when they were young. But national debt is really on them. Baby boomers are still firmly in control of Congress and spending right now, and they have been since the beginning of the expansion of national debt. It looks like we may never, ever actually see a Gen X president. I'm going to say that Gen X, because it's such a small generation, is probably going to get passed over in terms of presidents. We don't even have that many Gen X congressmen in power. I think Ron DeSantis would be the only Gen X person right now that I think has a chance of becoming president. And I don't know how likely that is to happen or not, but it's entirely possible that Gen X gets entirely passed by. And I say this because as a member of Gen X, I think that we're the most fiscally responsible generation out there. Of course, that is a biased statement. But one of the things I wanted to say, though, is that, despite this fact that this is an entirely a baby boomer issue because they have been at the reins of power, they've also been unwilling to discuss the debt in a serious manner without turning it into a political weapon of some sort. I fully expect that conversation to change as we see more millennials being elected into positions of power. Okay. So, So, and Tell 666-999 wanted to say hello to you as well. So, the debt limit was suspended between 2014 and 2016. And I'm going to say there wasn't really a good reason to do that. The economy at that point had been rescued from the Great Recession. It was just in the doldrums at that point, and we had really low growth at around 2% growth or so. It's still positive growth, but it's kind of a stagnating economy at that time. But on the other hand, of course, inflation was rather low. So, we'll talk about Vic. I'm going to get to your comment as well, because there are very good reasons to print money and ignore the elephant in the room when you are the world's reserve currency, and you can pay back with, and we'll talk about that. All right. So 2014, 2016, the debt limit was suspended for no good reason other than the fact that the government and the Federal Reserve wanted to keep borrowing rates really, really low to stimulate the economy back to that 3% annual growth rate, and trying to keep inflation around 2%, right? So once again, we establish a debt limit right around 2016, and then we suspended it again in 2018. Now, if you've been watching this channel for a while, so we had a debt limit from 2018 through 2000, or suspended from 2018 to 2020. Where was the crisis in 2018? Well, there actually was a crisis. It just isn't one that hit the headlines. And the fixed income market, especially in overnight papers, like commercial paper and short-term bonds, things like that, in September of 2018, that market almost collapsed. And the federal government had to go in and make certain guarantees in the short-term fixed income market. This is something that the stock market, if you notice, I think the S&P might have been down a little bit that year. The Dow was down about 4%. But other than that, there wasn't much of an impact. And there were the usual headlines predicting a dire economic recession. Now, I just want you to go backwards after this live stream is over and Google recession 2021, recession 2020, recession 2019, recession 2018, all the way back to like 2013 or 2011 or so. And you tell me, everyone back then was predicting a recession based on various political things, and none of those recessions happened. We basically haven't had a recession since 2009, since really about March of 2009. Since about November of 2009. It really wasn't evident, though, that the last recession that started in 2008 was over until about January of 2010, though. But it ended about November, December of 2009, right? So we weren't in a recession at the time. The economy was still growing, yet that debt limit was suspended in order to keep borrowing costs really, really low and allow the government to keep borrowing money as well to fund operations, rather than doing things that would have limited money supply, like raising taxes to pay off debt, or buying government bonds, or selling government bonds rather than buying government bonds. There were a lot of things that were going on that they just wanted as inflationary policies for the money supply. But in 2018, the government steps back in this time period here, and we see a pretty large run up in government debt as well. And what a lot of people don't remember is the fact that we were running almost $1 trillion deficits from 2017 through 2019, well before the pandemic. Okay, we don't see any of the debt associated with the pandemic until right about here, which would really be second quarter of 2020. By about April, that's when we see everything explode in order to rescue Congress. So even without the pandemic, we were probably still on track by this time to be somewhere around $25 trillion in debt, just by the virtue of the fact that our budget surplus as of 2017, due to a combination of increased spending and decreased collections and taxes, we were probably looking at an expansion of our debt, at least at a $25, $26 trillion range, which is bad by itself. The debt ceiling was hit this time on January 19th of this year. Treasury begins accounting measures to avoid default, which basically means shuffling around spending. And they've given us a little bit more than 6 months to solve this problem. So the problem is going to be solved. There's going to be a compromise, but it's going to come down to the last minute. And there's going to be a lot of uncertainty between now and when that is done. Okay. There's going to be a lot of stock market uncertainty between now and when that is done. There are a couple of different possibilities here when we take a look at what's going on here. And Barron's kind of lays this out really well in terms of scenarios. So, in theory, hitting the debt ceiling is going to lead to some dire economic consequences. If we don't come to a compromise by June, all government spending would likely suddenly stop. So, think Medicare, Social Security, and salaries for the military being cut off overnight. Now, that was done I think it was done in 2018. All right. And it was like, so the military continued to get paid all except for the Coast Guard. And I don't know if you remember that was because of how the way they divided up the Coast Guard between the Department of Defense and Department of Homeland Security, because the Department of Homeland Security was in charge of paying the Coast Guard. They ended up not getting paid. And I remember this because a number of people that train at my academy ended up not getting paid in 2018. And I ended up not making them pay for their membership for that brief period of time. Despite this fact, no one seemed to put the blame where it belonged, which was on Congress at that time, and the people that want to use this as a tool to make a name for themselves in government. There actually is no reason not to raise the debt limit and continue to borrow money to fund current operations, but there is a breaking point, folks, and the conversation has to be had that we need to reallocate our spending in a way that makes more sense. We do not need to be spending almost $1 trillion a year on our military. We just don't. We could cut 10% of the military budget and solve our nation's homeless problem almost instantly. I mean, it's not going to happen instantly, let's be honest, but with greater investment in mental health services, greater investment in getting people rehoused and relocated to areas where they're needed for labor, and really mental health services, addiction counseling, that sort of thing. 10% of the military budget could be reallocated to solve the homeless crisis overnight. This is the conversation that no one is willing to have, and the conversation that's still not going to occur, but we will see a compromise on the debt limit probably sometime within a couple of weeks especially when you look at the current composition of Congress right now and the number of just troublemakers out there that don't have any business being in Congress, aren't really there to make anyone's lives better. They're really just there to hurt other people. And there's just a few people in Congress that are like that. We're probably going to see this come down to the wire in this case. There'll be a last minute compromise. And in between now and then, there's going to be a growing amount of uncertainty when it comes to the stock market. So in theory, though, the Medicare, Social Security not being paid, however briefly, is a big deal for the people that don't receive their checks. But in the long run, not such a big deal because they're going to get paid back and they're going to get paid back pay as well. What really is the big issue here and would be more dramatic would mean that the government fails to pay interest on bonds that it's already issued. This would affect the credit rating of the United States. Now, this needs to come with a caveat, of course. We came very close to not paying our interest on our bonds in 2018. And then the government at the time, or the president at the time, started talking about renegotiating U.S. debt, which you cannot do that on a bond. You don't get to renegotiate a bond unless it's a callable bond, but that's a whole different story. Treasuries are generally not callable, right? But I can't think of any callable treasuries. But in that case, though, if the government failed to pay interest on a bond, or even got close to not paying interest on a bond, that could affect the credit rating of the United States. What does that mean? It means that yields are going to be higher and people are going to be willing to pay less money for credit issued, for bonds issued by the United States. Now, what happened in 2018, though, was counterintuitive. It was the actual exact opposite of that. So we had something very similar happen in 2014, where we had kind of a debt limit argument and then it got suspended. And then in 2018 with a debt limit argument, and then it gets suspended again. In both of those time periods, we got really close to defaulting on our debts, and then we didn't default. And what S&P thought when they downgraded the United States from AAA to just AA or whatever their ranking system is. I forget between Moody's and S&P. What happened is actually yields declined, prices went up on bonds, and foreign governments and individuals bought more U.S. dollars or more U.S. bonds, right? More U.S. debt, which is counterintuitive. You're looking at a country that came within a hair's breadth of defaulting, and now you're going to buy more of their debt. So it's not about how good we are in those time periods. It's about how bad the rest of the world looks. We could be looking at a similar situation right now as well. Regardless of how bad the United States looks by almost defaulting on its debt, the fact is we can pay our debt moving forward. The issue is I think that what we're getting here is basically a positive feedback loop here, where the behavior that we're going to exhibit over the next 6 months is actually going to be encouraged by the reaction of the fixed income market. And a lot of that has to do with foreign interest in our debt. They're going to be borrowing more of it because everyone else is in worse condition. That's just the way things are. I think that's all it does is delay this argument that we need to have about foreign debt and we need to have about fiscal responsibility, and pushes it off later and later and later, where the problem is going to be larger and larger and larger. And who knows how large that's going to be. The last time we had a balanced budget was sometime between like 1998 and 1999. And that was during sort of the very beginning of the dot-com boom, right before the dot-com crash. A lot of that was driven by capital gains. A lot of that was actually driven by higher tax rates as well. During the Clinton administration, we had higher top marginal tax brackets. We had fewer deductions, at the business level. And now we have less in the way of raising taxes on the wealthy here. It's not that the wealthy actually pay the majority of taxes either, right? If you look at the Tax Cut and Jobs Act of 2017 that was passed during the last administration and by a Republican Congress, that was a pretty good tax bill at the time. It's not necessarily one that we needed, though. It provided a small cut in taxes for the middle class and guaranteed that between now and 2027, taxes are going to go up every single year on the middle class. That is part of the bill. And then the bill sunsets in 2027, and the new tax bill is going to have to be passed at that point. But basically, taxes are going back to the old rates that they were in prior to 2017. Which honestly, I'm not a huge fan of paying taxes, but right now we do have a revenue and collections problem, despite what people are saying politically. The reality is we have a revenue and collections problem at this point, with a large portion of the population not paying any taxes at all. And if you ever raised money for like a really large organization, I did this for the United Way a couple of times, the approach that you take there is not to go after a bunch of really big donors, because you're going to get some of them and you're not going to. But the reality is there just aren't enough of those really big donors to make a dent in the huge amount of money you need to collect. And it's actually better and easier to collect a small amount of money from a giant amount of people. And that's the issue we have right now, is that we're concentrating all of our debt collection or all of our tax collection interest right now on the top 50% of income producers. And really that 50 to 80% of income earners are the ones that I'm talking about, income classified as ordinary income, not capital gains and not dividends. We're concentrating our tax collection issues on that 50 to 80% right now, and it's not generating enough money because there aren't enough of them at this point. The vast amount of wealth is actually generated through capital gains in the United States, through capital gains and through dividend payments, and taxes on, or tax rates on those ostensibly were lowered to encourage investment. What it has resulted in, of course, is not greater investment. It's really technology and ease of investment that has created a wider market of folks that are investing in markets now. Like, I have a lot more people to talk about the stock market to and investing in than I ever did back in the days when I first got my start in the financial industry. There's just more people investing, but that's all technology and has nothing to do with the actual tax code. If tax rates were the same what they were back before there was a capital gains tax, people would still be investing today for the chance of making money. So let me see here. So Tel666999 says, for me, with certain layoffs, and although governments of UK and US haven't officially said they're in a recession, for me, clearly, top organizations is no. So there actually have been a number of different periods where we've seen tech layoffs in anticipation of a recession, and the recession never happened. It looks more and more likely, like I said a year ago, that this recession looks to be shallow and kind of long lasting rather than really sharp and really deep and really painful. We're probably looking at a best case scenario is going to be an earnings recession where we really don't see a decline in GDP, but because of the pressures of inflation, what we see is a decline in profitability for companies. So a lot of what is going on right now that's making the news are tech layoffs. Tech layoffs in particular, like I said before, we've had a number of those where the recession never happened. In this case, though, this is a preemptive strike against an earnings recession. Basically, they're shoring up their balance sheets and cash flow reports and profitability reports right now in anticipation for what comes next quarter and the quarter after that. They probably see some reduced or like a shifting of spending away from tech products into other things like food, other thing, and just other parts of the economy. Even if we don't see a recession, we're probably going to see a de-emphasizing of tech dollars being spent over the next couple of months to a year, and this is likely a preemptive strike against a decline. I mean, if you think about it, I think that overall Microsoft has more than 200,000 employees. So them announcing that they're going to lay off 10,000 people is somewhere less than 5% of their workforce. The same was true of the Amazon layoffs. The same was true of the Salesforce layoffs. And then you have to look at the amount of hiring that Microsoft has done since 2020. They've hired something like 80 or 90,000 people just since 2020. And when you look at the scale of that hiring, how well those employees are integrated, when you were going to get rid of some of them anyway, you don't keep in the tech field, you don't keep 90% of your employees. You just don't. You don't keep 80% of your employees. You let go quite a few of them. They're just not the right fit for your company, and you're not going to find a way to make them work. So this is just opportunity at this point. When we see a second round of layoffs, that's kind of when I'm going to get a little more concerned. First round of layoffs to me is not deep enough. It's it's not deep enough. It's not broad enough, and some of this has to do with companies realigning. If you look at Meta's layoffs, a lot of that has to do with their realignment towards the metaverse, and you can comment what you want on that. That's like a whole other video on how that has been just absolutely screwed up. So, yeah. Let me see here. Morning, Jason. I really think that the U.S. needs a national consumption tax. The only way to get the wealthy to pay their fair share. So I have an idea that's like really unpopular, really, really unpopular. But I think that we should probably change the way capital gains are taxed, and the way like dividends from S corps are taxed, and dividends for C corps are taxed for insiders, right? So for people that hold more than a certain percentage of a company, the dividends that are distributed to you or people who own S corps, we need to tax those a little bit differently, and that's probably a better way. Like for example, I own a bar. I don't really work there, but I could pay myself a nominal salary of $1,000 a month, which based on the time that I put in there, that would actually make me a pretty highly paid employee there, and I could take the rest of the profits a dividend as a dividend distribution if we took an S corp election for the company, which would mean that I would pay a maximum of 15% taxes on that, up until the point where I have to pay the additional Medicare tax. But the most I would pay on those earnings would be like 18.1%. That would be the absolute most that I would, even if we were making millions of dollars, which isn't going to happen. But even if we were making millions of dollars off of that bar, I would pay a maximum of 15%. And this is one of the ways that companies or people that own companies are allowed to escape taxation. This is one of the things that gives them the ability to invest in more. Like if I earn $500,000 from that bar, I'm paying about 15% of my, at a maximum 15% of my overall earnings from that bar in income taxes, but that's going to be in the form of capital gains tax. A doctor who earns the same $500,000 under the current tax code would pay like $140,000 in tax. So their overall effective tax rate would be roughly like 25% or something like that. And mine would be about 15%. And every dollar they earned on top of that is going to be taxed at 37%, right? So that's why that, I mean, this is a doctor who works for like Kaiser, like one of the major HMOs, because they're employees. They're not independent contractors and they have their own businesses. They're actually going to pay a lot more in taxes than I will as a business owner. And plus my business already got deductions for everything we paid in salary, for business losses, for depreciation of equipment, all that stuff, right? That's the part of the tax code that would probably be need to be reevaluated. I think that everything that comes out of the company and goes into the pockets of the owners, we have to reevaluate how that's taxed. And I say this as someone who enjoys that preferential tax treatment, but honestly, there's no reason why like I should be paying less in taxes than a school teacher does. And I can tell you that if you have a family with 2 school teachers who teach in California, they're paying more in taxes than I do just because of how they are paid, and they pay more in taxes than I do. And even though they have a lot of unreimbursed business expenses, like in the United States, teachers pay for a lot of their own supplies out of their own pockets for classrooms, like things like paper, chalk, pens, all that stuff. I know that's hard to believe, but it's actually true. And they do a lot of fundraising in schools from parents to defray those costs, even though we're all paying out the nose in property taxes. So yeah. So Vic says, what debt? They will continue to print money and ignore the elephant in the room. So the reason they've been able to print money and ignore the elephant in the room is because they've been issuing long-term debt at a rate of just under 3% for more than a decade, which when you factor in inflation, when you factor in inflation, and remember inflation compounds, that even if the interest rates are the same, by the time, meaning if you issue debt at 3% and the inflation rate is at 3%, remember that inflation compounds and the interest on the debt that you're getting from the bond doesn't compound. By the time that bond matures in 30 years, you're paying back that principal in much depreciated dollars that have lost a lot of their purchasing power, right? And remember that like government is not responsible for the trades that bond goes through in the next 10 years, like how many times it changes hands. All they're doing is paying the coupon to whoever owns the bond. And at the end of the period, they pay back the 100,000 or, the $1,000, $100,000, whatever the bond is worth. Right. So in that case, it's made a lot of sense to borrow money when interest rates are really, really low. And it's made a lot of sense to basically sort of basically renegotiate the debt that existed before at a much higher interest rate and then reissue it at a lower interest rate. So essentially, we have not paid back any debt over the last 12 years or so, but we've gotten to refinance almost all of the debt from a time period when interest rates were much, much higher. You were seeing bonds that were issued 30 years before at 10, 11, 12, 13%. And by the time bond holders actually received their principal back, they were only able to purchase that same fixed income, that same fixed income trade and doing it at 2 and 3%. So there was a huge refinancing of debt. That's probably the wrong word for that, but there was a huge sort of recycling of debt at lower interest rates, which made it a lot more palatable. So it's not the same thing as debt being 100% of GDP at the end of World War II versus 100% of GDP at the end of 2008. Not the same thing because interest rates were wildly different. And so this time around, though, we are looking at much higher interest rates than the last 2 times that we suspended the debt ceiling. So the debt ceiling is going to be renegotiated. But look, guys, this is a different ballgame in this respect. We're going to see long-term, at least we're going to see interest rates on long-term debt probably rise pretty quickly as we go through this. And for the smarter members of Congress, this is going to be an incentive to come to an agreement and get this done. For the dumber members of Congress, they will not understand how balking and stalling on this is actually going to hurt the economy as a whole and hurt ordinary Americans. So I did want to say thank you for the super chat. I don't get a ton of super chats, but I always appreciate them when I do. And you're a frequent watcher of the live stream, and I just wanted to say thank you. So here, with all things considered, inflation was at target of 2%. what is the ideal interest rate? For me as a saver, I always feel that the savings rate will be lower inflation. Yes, the savings rate is lower than inflation by design. The savings rate is always going to be, let's put it this way, it's always going to be lower than whatever your 10-year treasury rate is for the most rates. Like right now in the United States, the yield curve is inverted, meaning that short-term interest rates are longer than some are higher than some long-term interest rates. Like you can go to SoFi right now and get a savings account that pays 3.75, or I don't know what treasury rates are today. Let's take a look at that real quick. Let's see if we have treasuries up on this screen. Yeah. So in the United States, you can get a 5-year treasury at 3.483% yield to maturity, a 10-year at 3.93%, or you can stick your money in a savings account at SoFi and get 3.75. Which one is the better deal, right? But that's not normal. Typically, you see a spread between the 10-year treasury and savings rates, and usually that's somewhere around 2.25% to 2.5%. And so, and spreads between deposit rates and loan rates have been really, really small in the last decade or so. You've been seeing like deposit rates at 0.25 to 0.5%, and loan rates as low as on a 30-year basis as low as 2.75% or 3%. And that's been we're never going to see those again, in my opinion. So a couple of things here. In terms of fighting inflation, we're looking at the UK, which has raised interest rates almost to the level of being restrictive here on a 10-year basis. That's what the market has done. Germany is not doing their fair share. I'm being a little unfair here, right? It's the market is bidding up Germany's debt because they trust that Germany is going to pay back on their bond obligations. Spain as well, which in Italy, not so much, right? Remember, these Germany, Spain, Italy, these are they're on the euro, and the supply of the euro is controlled by the European Central Bank. The delta that you see here is faith in the government's ability to pay back their bonds, meaning that there's a difference between what investors believe that Germany will have the ability to pay back a 30-year bond, or Italy will have the ability to pay back a 30-year bond, or China or Japan. Yields rising on Chinese debt in the long term actually have me a bit concerned. And I bet if the market were allowed to flow a little bit more freely, that those would be quite a bit higher. So China actually saw, and they just announced this last week, China announced a reduction in population last year of 850,000 people. And there are already scientists out there, demographers out there, who are saying that that is a vast underestimate. And they think that the population of China is probably somewhere around 1.5 million to 2 million people smaller than people think it is at this point. And I mean, just last year, 1.5 million to 2 million people is what the population decline was, and that they may be missing a good 30 or 40 million people out of their population one way or the other. And I was reading an article on this. I'm not sure, based on where it's published, though. I'm not going to give you a link to that because I'm not really sure about where it was published or the academic journal, because I don't read about demographic sciences and statistics. Like this is like basically a journal for like academic statistics, right? Number one, it was a really boring read. But number two, I'm not really sure of the provenance of this article or this journal, so I don't want to comment on that. So yeah, okay. But yeah, national consumption tax. Back to national consumption tax. We actually have a problem with that. So there's a constitutional issue with taxing interstate commerce, commerce between two states. A national sales tax or consumption tax has pretty much been dead in the water with Congress, largely because it would have to be litigated. As soon as you propose it, even if Congress voted on it, it's going to be litigated, and you're going to be sued out the wazoo, and it's going to take a decade before all of those go through the Supreme Court. And I do think that the current Supreme Court would probably shoot it down. So we do have some consumption taxes on gasoline. We have some consumption taxes on a few other goods. But like a national sales tax might not be a bad idea as well. But no, I don't think that a consumption tax is a way to get the wealthy to pay their fair share. And I don't know who you consider wealthy either. But there's a whole lot of people in the top quartile of of income earners that really aren't that wealthy. And there's a whole lot of people who aren't in the top quartile of income earners who find ways to limit their income, who are extremely wealthy through through capital gains. The proposal has been made from time to time to have a tax on unrealized capital gains. Which, if you had a tax on unrealized capital gains, it's actually going to cause an exercise of it's basically going to cause sales of things in order to force capital gains. That would be super hard to basically super hard to enforce. I think a better way to start, like I said, is just to change the characterization of the taxation of dividends that are paid out to insiders. That's probably the best way to do that. And that would affect small business owners that are making $500,000, $1 million a year, who end up finding ways to reduce their taxable income down to like $85,000, $86,000 a year. And I saw a number of those while I was doing tax planning in the last 2 years, where there were companies owned by an individual who they paid themselves a salary of $90,000 a year, and they paid the rest of their salary, $900,000 or so, as a dividend, and they paid almost nothing in taxes, right? And the other thing is they avoid paying payroll taxes on that too, so they don't have to pay taxes that fund Medicare, taxes that fund Social Security. He wasn't even taking up to this person I'm thinking of wasn't even taking up to the Social Security maximum in that case. And they were, which would be, I think, somewhere around 137,000 in income. So I wasn't even paying up to the Social Security maximum at that point, and was taking the rest in capital gains. So really kind of shorting the sort of Social Security thing there. So yeah. So there's been a massive cut in the budget. Need to move my stocks and shares. USA. Okay, I'm not sure what you mean there. CGT has been massively cut in UK budget. Need to move my stocks and shares. ISA. So not sure what you mean there. By the way, I remember I don't know all of the acronyms overseas. Let me see here. Thanks, Jason. Always appreciate what we do. Take care. Thank you so much, and I hope to see you next time here. All right, guys. One of the things that's coming up here pretty soon that you want to pay attention to is earnings. We are in earnings season again, and it's really the next 2 to 3 weeks. We're going to see a lot of different earnings, right? Tomorrow, before market open, we see Ally Financial. Generally, when a company schedules earnings before market open, it's pretty good. So I've been looking at in particular, a lot of earnings from financial companies, and I can tell you that there've been a few negatives out there, but on the balance, it's been not so bad. Not anywhere near as bad as I expected it to be, which this is the third quarter in a row that for the financial industry, things have been not as bad as I thought. So I am anticipating that we're going to see a fairly good quarter from SoFi, though. They've got a few wins blowing their way. They've taken a few chances that have really paid off for them. So I do own a little bit of Ally Financial. I own 100 shares of Ally. I remember the reasons that I bought them. It was really sort of like a portfolio stabilizer at the point, adding something that I was familiar with in the financial industry that wasn't going to have the same volatility as a lot of the other companies that I own. And I just want to be heavily invested in financials right now as they're declining, as they're hitting kind of lows right now. I want to be heavily invested in financials, waiting for that turnaround and that re-expansion of the economy. So I'm not investing for now or 6 months from now, 9 months from now, really investing for a year to 10 years down the road. I'm a long-term buy and hold investor. I don't do a ton of sales. When I do sales, usually I talk about them. I talk about them first in my Patreon group because they pay to be a part of my Patreon. So they kind of get first wind of whenever I do a sale. I haven't sold anything lately, but that may be changing pretty soon. So these are the earnings that are coming out. Ally Bank, Huntington, BNY, Mellon, West America Bank, Banner Corp, Metropolitan Bank, Bencha Holdings, Main Street Bank, Ocean First Financial, Regions Financial, Capstar Financial, State Street, really big one. MedMen Enterprises. I think that's a weed business, and I think they have a couple of those in my town here. And a lot of companies here, of course, which is an oil field services company. that is oilfield services is one area that I expect to sort of pick up here in the near future. We are seeing a little bit of an increase in oil demand. We're seeing a little bit of an increase in oil prices right now. Expect that to continue to increase through summertime. Oops. Sorry, guys. Always had a little alarm set at 2:10 to remind me that I need to start getting ready to go to the academy. All right, guys. I am going to cut this one a little bit short today. I just wanted to cover a little bit on the debt ceiling. I did want to talk about a little bit about Tesla Day, but I didn't have questions on Tesla or anything like that. But there is some news that's coming out there, but I'm going to save that to when we have a little bit more to talk about. But I did want to thank everyone for attending today. It's been a bit of a slow week in the market. Inflation numbers look pretty good. Unemployment numbers look pretty good, which the market didn't like. Okay. Because we don't have enough people claiming unemployment. But I'm going to say once again that the difference of 10 or 15,000, when you get down to unemployment claims at this level, it's just not significantly, it's just not statistically significant. Like unemployment claims basically have to double before we can really say that the economy is losing jobs, right? You can't really say the economy is losing jobs until unemployment claims double from where they are right now, which is roughly 190,000. Once we get close to that 400,000 level, you can say definitely the economy is losing jobs. In any normal economy, when unemployment claims dip below 350,000, that is the point where you say, okay, the economy is growing again. So it doesn't need to just get past 350,000. They need to be somewhere north of 400,000 before we can say the amount of jobs out there is finally smaller than the number of people seeking jobs, right? Until that happens, we still have an issue with wage inflation. We still have an issue with rising wages, all right? So just don't pay too much attention to those really temporary numbers right now because the differences in terms of employment, because it's just not statistically significant. Anyway, folks, I wanted to thank you and check out the links in my description. I never remind people to do that. Also, the thumbnail that I did today, I used an AI image generating software to generate the background for the thumbnail of the frustrated investor with the hands on the head. That is a completely fake image. It was done by the DALL E2 AI generator where you stick in a line of text and it generates an image. You can sign up for it for free. It's through the same OpenAI company that does Chat GPT. And I gave Chat GPT some crazy prompts and it came up with some great stories. And yeah, but and Deweese, Bram, you're always welcome to comment on the U.S. economy. I tend not to comment on foreign governments that are democracies. I don't comment on their government. That's all. I comment on everyone else's economy if I know something about it, right? And I welcome comments on our economy as well. The only reason I don't comment on other governments that are democracies is because I feel it's kind of hypocrisy to do so. But I will comment on dictatorships all day long. Anyway, did want to say though, between now and the end of this debt limit fight, there's going to be a lot of volatility and a lot of opportunity to snap up stocks that are going to be unjustifiably beat down. So don't think that the market is completely turned around. We still have some volatility ahead of us. And I say that we have some volatility ahead of us probably through July, August of this year before we really see a market snap back. Anyway, I am out and I will see you guys on Monday for sure. Thank you very much.